Hello, I'm Sim and welcome back to my YouTube channel. I'm a fitness expert and a self-proclaimed foodie. And before we begin today's video, I have to talk about this delicious matcha I had from this cafe in Dubai. It's called Rumaila's Farms, and if you're in Dubai, you definitely have to try it out. In today's video, we're going to be talking about how much of your income to invest in the stock market, how many stocks to keep in your portfolio at any given time, what are the top sectors to invest in, and of course, I'm going to be sharing with you some top stocks to invest in these sectors as well. So make sure you watch the video till the very end. So let's begin with the first question of how much of your salary should you invest. The sweet spot, according to most experts, is 15% of your pre-tax salary. This is how I would think about splitting your monthly income. 50% out for your basic expenses, which is your rent, your car, your basic food, groceries, things like that. Then you take out 5% for an emergency fund, 15% including your employer's contributions into investing, and the rest into everything fun that you want to do, which includes your vacations, your eating out, your gifts for your partners, whatever it may look like for you. Now, if you're a newbie, I'd say invest 70% of this 15% that you're investing into mutual funds or ETFs and the remaining 30% into stocks. So as per definition, ETFs are a collection of assets, often stocks, bonds, or a mix of two as well. ETFs provide diversification benefits, that means lower risk and lesser volatility, and it's safer to invest in ETFs than in individual stocks. Some good ETFs to look at are the ones that replicate the S&P 500, the Dow Jones, the Nasdaq, or even the Russell. Two good companies that I usually look at for ETFs is Vanguard and iShares. There are also ETFs that are specific for industries like semiconductors, home constructions, automakers, technology, and various other industry segments. So what I typically do is look at the 5, 10, 15, 20-year returns and then decide which ETF I would go with. Now, in addition to ETFs, you should also hold 20 to 30 stocks into your portfolio to ensure that you have a diversified portfolio, which means lesser risk, lesser volatility. Given what's happening in the US right now, it's very difficult to have stocks that have low volatility, but in comparison to the market, you can have stocks that have lower volatility. And the ideal number of stocks to have in your portfolio is anywhere between 20 to 30. I like to keep 30. Now, there are 11 sectors as well, which you should ideally cover in all your 30 stocks. They're essentially IT, healthcare, financials, consumer discretionary, communication services, industrials, consumer staples, energy, utilities, real estate, material, and you can invest in stocks across all these 11 sectors so that you have a diversified portfolio. Now we get to the exciting part that you've been waiting for, is my stock recommendations across these sectors. So in today's video, I'm going to be telling you 5 stocks to invest in. The first one on my list is a technology company called Arista Networks. They deliver products across data center and campus with routine and software solutions for monitoring and network detection and response worldwide. They serve financial institutions, cloud companies, and virtual assistance companies. Now, like most of you, I don't understand this tech jargon, but what I understand in simple terms is that they are an industry leader. Their biggest customers are Microsoft and Meta and some other clients who are investing heavily in building an AI infrastructure. And now we know that every tech company is looking to build their AI infrastructure. Now, I can't bet on the fact whether Apple will get their AI right or not, but I know that they will need Arista network services and products to build their AI infrastructure, which just means more sales for Arista and better the stock performs. Their president and CEO, Jayashree Ulal, is phenomenal. She's a great leader. She has great visions for the company and is definitely one who takes action on the vision. If you go through their Q1 2024 deck, you will see that there's a $60 million target market that they are yet to serve. And so far, they've depicted really strong market share growth as well, which is very important because this just means that if they are gaining market share, there is a 60 billion market, they're just going to grow. So far, they have really strong EPS growth of 39.2%, their revenue growth of 16.3%, and this is year on year, mainly led by strength in their enterprise segment. They also announced a share repurchase program of $112 million, which just means that the company thinks their share is undervalued and you should be getting in now. The second one on my list is Alpha Metallurgical Resources, or AMR. It's a leading coal supplier with underground and surface coal mining complexes across northern and central Appalachia. They use their coal to make steel, which is essentially used to build roads, any construction, bridges, vehicles, and even household appliances. It's extremely critical for the energy industry too. 37% of the export sales come from India, and we need to see how well Indian steel companies are doing to see if they can meet their demand in India locally. However, if they're not able to cope up, India is definitely going to grow. Their energy requirements, their steel requirements are only going to increase, and that means this company is going to grow. They've also done 5 share repurchases since 2022, which means that the company feels that their stock is undervalued. And as an investor, you're getting a chance to cash in, so why not? I also heard their earnings call and I noticed that their capex is about to reduce, which means just higher profits in the long run. I know what you're thinking now. You're thinking that, okay, the US demand for coal has been decreasing since 2007, so why should I invest in a coal company? This coal company is very different because they have a very different type of coal which they can use to make steel, which is very important in electrification of everything. This is definitely a stock you need to hold for at least 3 to 5 years and even much longer to see how this plays out. So I understand it's a risky one, but if you're in it for the long run, you're definitely going to be rewarded. The next one on my list is Echo Labs, and I know that it was doing badly in late 2022 till 2023. But after listening to the earnings call this season, I was so in. The company is doing phenomenally. They have some great enterprise contracts already in place. And what I really like is that they are serving so many different industries and sectors, be it power, be it healthcare, or retail. So, what the company essentially does is that they develop and offer services, technologies, and systems that specialize in treatment, purification, cleaning, and hygiene of water in a wide variety of applications. I also love investing in B2B businesses. There's more stable revenue and each contract value is so much significant. I've also been a private equity investor for the past 6 years, and I know that D2C brands are currently struggling. And so I always look away from them and I focus more on B2B businesses. They declared really good Q1 results. They saw strong organic growth. Their adjusted EPS increased by 52% to $1.3. Their management team is really strong, and I see that they are just looking to grow the business, their operations, and their enterprise contracts. So it's definitely an investment to add to your portfolio. The next one on my list is again a market leader in the financial space. I'm pretty sure you all probably know it and already have it in your portfolio. In case you don't, you need to get it. It's Goldman Sachs. The price of the stock has been gradually increasing from $339 a share in November of 2023 to $467 now, which is amazing. There's no surprises coming in here. The diluted earnings per common share was $11.58 for the first quarter of 2024 compared with $8.79 for the first quarter in 2023 and $5.48 for the fourth quarter of 2023. So results wise, the company is doing phenomenally. Their assets under their supervision have also increased $36 billion during the quarter to record a $2.85 trillion portfolio. The firm also ranked number 1 in worldwide announced and completed mergers and acquisitions for the year to date, which is amazing. If a company has been number 1, is winning number 1 awards repeatedly and consistently, it's a company you need to add to your portfolio. Your kids will be thanking you for this one. On April 11th of 2024, the board of directors of Goldman Sachs declared a dividend of 2.75 per common share to be paid on 27 June 2024 to all common shareholders. And usually the stock prices fall after issuing the dividend, so try to see if you can buy it at that point. The last one on my list is a home construction company called D.R. Hortons. And now that the Fed is going to cut interest rates because the CPI results came in better than expected, it maybe won't happen in the June meeting, but it's definitely going to happen this year. A lot of people are going to buy homes, and I want to buy the market leader. So D.R. Horton is the largest home builder by volume and has good liquidity. Their performance in Q1 2024 has been positive with a net income of $947.4 million or 2.42 per share. Their new home orders increased by 35% to 18,069 and their total revenue was $7.7 billion. I don't want to find smaller, high growth stocks in the home construction business because we're still unsure about when the Fed is going to cut rates and when the industry is going to boom. So I'd go with a market leader. so that I know that even if the Fed cuts rates in November, this company is a market leader, the fundamentals are good, they have good liquidity and cash management, and will continue to give me positive returns. Another sector you may want to look at is clean energy stocks. Now that Biden has imposed tariffs on China, a lot of the local demand is going to be met by local companies, and that just means clean energy stocks are going to have more contracts from local companies, more revenues coming in, and so the stock prices will go up. More on this on the next video on how the new tariffs imposed on China are going to impact the US industries, which stocks to look at that are going to benefit from this tariff, and which stocks are not going to benefit from this tariff. So make sure you subscribe to my channel and see you next week. Bye.